It's official. The recession signal just triggered one number, one yield, 4.03%, and the bond market, the most sophisticated financial system on the planet, just said something. It has only said 3 times before, in 2007, in 2019, and in 2022. Each time, something broke. But this time, the debt is bigger, the deficit is deeper than silver is sitting on a trigger that could make everything before it look like a rehearsal. The catapult is loaded, the fuse is lit, and what happens next will either protect your wealth or erase it. Stay with me. Welcome back to John Analyst. Now, if you've been around long enough, and I suspect many of you watching this have, you know that the most expensive words in business are "I didn't see it coming." This channel exists so that those words are never yours. If you are new here and you value your financial future more than your comfort zone, hit that subscribe button right now. Think of it like this. You wouldn't cancel your morning newspaper the day the headlines finally got serious, would you? This channel is that newspaper. Except we don't wait for the crisis to explain it to you. We tell you before it arrives. So subscribe, ring that bell, and make sure this reaches you when it matters most. Because that moment may be closer than any of us would like. And before we go further, drop a comment below and tell us, where in the world are you watching from today? Whether you're in New York, London, Dubai, Karachi, or somewhere in between, I want to know who is paying attention. Because the people paying attention right now are the ones who will be prepared. Let's begin. On the morning of February 2026, something quietly happened in the bond market that most people completely missed. There were no breaking news alerts, no emergency press conferences, no dramatic headlines on the front pages of financial newspapers. The stock market was still open, corporate earnings calls were still being scheduled, business anchors on television were still talking about quarterly growth projections and sector rotation strategies. But deep inside the machinery of the global financial system, one number moved. The 10-year Treasury yield dropped to 4.03%. To most people, that sounds like technical noise. A small decimal shift on a data screen that only Wall Street analysts care about. But to anyone who has studied the history of financial crises and studied it carefully, that number was not noise. That number was a warning siren. Here is what most people do not understand about the bond market. When a government bond yield falls, it means bond prices are rising. And when bond prices rise sharply, especially in an environment where the official narrative says the economy is doing fine, it means one thing above all else. Institutional money is running. The largest, most sophisticated investors on the planet, the ones who manage pension funds, sovereign wealth portfolios, and trillion-dollar insurance pools, are quietly moving out of risk assets and into the perceived safety of government bonds. They are not doing this because they are optimistic. They are doing this because they are afraid. And they are afraid because they are seeing data that the general public will not see until it is far too late. This is how it always begins. Not with a crash, not with a headline, with a yield. History is patient, but it is also remarkably consistent. In late 2007, the 10-year Treasury yield began falling, while financial television was still reassuring the public that the subprime mortgage problem was contained. The Federal Reserve Chairman himself stated publicly that housing market problems would not spill over into the broader economy. The bond market disagreed, quietly, persistently, and it was right. By September 2008, the world understood what the bond market had been communicating for nearly a full year. In late 2019, the yield curve had already inverted. The repo market, the overnight lending system that keeps the financial system functioning, was experiencing severe stress. The Federal Reserve was injecting billions of dollars into overnight funding markets and carefully avoiding the word crisis. 6 months later, March 2020 arrived and every asset class on the planet sold off simultaneously. In 2022, the 2-year Treasury yield climbed sharply above the 10-year yield, creating the deepest yield curve inversion in 4 decades. The bond market was predicting that the Federal Reserve's aggressive rate hike cycle would break something, and it did. Silicon Valley Bank collapsed. Signature Bank collapsed. First Republic collapsed. Those were the visible breaks. The invisible breaks, the ones buried inside commercial real estate portfolios and regional bank balance sheets, are still working their way through the system today. 3 warnings, 3 crises, the same signal each time. And now in February 2026, that signal has appeared again. What makes this moment different from those previous episodes is not the signal itself. The signal is familiar. What makes this moment uniquely dangerous is the condition of the patient receiving it. In 2007, the United States carried approximately 65% debt to GDP. Today, that number stands at 127%. The national debt has crossed $37 trillion. Annual interest payments on that debt are approaching $1 trillion per year. Not to reduce the debt, not to fund infrastructure or defense or social programs, but simply to service the interest. just to keep the lights on in a system that has been borrowing from its future for 2 decades without interruption. The economy that is receiving this yield signal today is not the economy of 2007. It is heavier. It is more leveraged. It has far less room to absorb a shock before the structure begins to crack. The bond market is not confused. It is not making a mistake. It is doing what it has always done, telling the truth before the headlines catch up. And in February 2026, the truth it is telling is this. The recession signal has not just appeared. It has triggered. There's a moment in every financial crisis that nobody talks about afterward. Not the collapse, not the recovery, not the dramatic headline that finally forces the mainstream press to acknowledge what was already visible for months. The moment nobody talks about is the quiet one. The one that happens before everything else. The moment when the first large institution, somewhere behind closed doors in a boardroom that will never appear on television, makes a decision. They decide to raise cash. That decision does not make news. It does not move markets visibly. It does not trigger any alarm that the average investor, the average business owner, or the average person managing their retirement portfolio would ever detect. But it begins a chain reaction. And that chain reaction, once started, follows the same pattern every single time in modern financial history. Understanding that pattern is not optional anymore. It is survival. The pattern has 2 phases, and confusing one for the other is the single most expensive mistake a serious investor can make. Phase 1 is the liquidity crush. When economic stress builds to a critical threshold, when the data deteriorates past the point where institutional risk managers can justify their current positions, large investors do not wait for confirmation. They act on anticipation. And the action they take is always the same. They sell whatever is liquid. Whatever can be converted into cash quickly without moving the market against them gets sold first. Gold is liquid, silver is liquid, oil is liquid, stocks are liquid. This is why, in the early stage of every major financial crisis, precious metals fall alongside equities. Not because the investment thesis for hard assets has broken down, not because silver or gold have suddenly become less valuable in any fundamental sense, but because the institutions that need dollars right now will sell anything that gives them dollars right now. This is exactly what happened in March 2020. Silver dropped from $18 to $11 in 2 weeks. $11. Forums were flooded with investors declaring that the entire precious metals thesis had been permanently discredited, that anyone who believed in hard assets had been proven foolish by the market itself. They were looking at phase 1 and calling it the final verdict. It was not the final verdict, it was the setup. Phase 2 is the Fed response, and this is where the entire financial picture inverts. When recession conditions become undeniable, when unemployment rises, when corporate earnings collapse, when credit markets freeze, when the tax revenues that fund government operations begin declining, the Federal Reserve has one move. It has always had one move, and it has executed that move without exception in 1990, in 2001, in 2008, and in 2020. It cuts rates. It expands its balance sheet. It injects liquidity into the system at a scale that would have seemed unthinkable in any previous generation of economic management. In plain language, it prints. And when it prints, the dollar loses value. When the dollar loses value, hard assets reprice upward. When hard assets reprice in an environment of structural supply deficits and collapsing real interest rates, the move is not gradual. The move is violent. After the Federal Reserve announced unlimited quantitative easing in March 2020, silver went from $11 to $29 in 5 months. A 160% move. After the 3 rounds of quantitative easing that followed the 2008 financial crisis, silver climbed from $8 at its crisis bottom all the way to $49.50 by 2011. A return of more than 6 times from the lowest point of the panic. Phase 1 looked like defeat. Phase 2 delivered the result. Now consider the mathematics of the current moment with clear eyes. In 2020, when the Federal Reserve cut rates to 0 and launched unlimited quantitative easing, the national debt stood at approximately $27 trillion. Today, it stands at $37 trillion. The annual interest burden alone is approaching $1 trillion. The debt to GDP ratio has crossed 127%. The Federal Reserve in 2026 is not walking into this recession with the same tools it carried in 2020. It is walking in carrying significantly more weight into a system that is significantly more fragile, with a silver market facing a structural supply deficit that did not exist at anywhere near this severity 6 years ago. The response will need to be larger. The monetary injection will need to be larger, and the repricing of hard assets in response will need to be proportionally larger. Phase 1 happened. The yield confirmed it. The liquidity selling confirmed it. Phase 2 is not a possibility. At 4.03% on the 10-year Treasury, with the debt structure that exists today, with the Federal Reserve's entire documented history as evidence, Phase 2 is a mathematical inevitability. The only question serious investors are asking right now is not whether it comes. It is whether they are positioned before it arrives. There's a metal sitting in warehouses, vaults, and coin shops across the world right now that the financial establishment has spent decades teaching people to ignore. Not gold. Gold gets the headlines. Gold gets the central bank endorsements. Gold gets the respectful mentions in serious financial publications when the economic outlook darkens. Gold is the metal that institutions feel comfortable acknowledging publicly without risking their professional credibility. Silver gets the dismissal. Silver gets the raised eyebrows at investment committee meetings. Silver gets quietly left off the asset allocation spreadsheets of firms managing billions of dollars on behalf of people who trust them completely. Silver gets called a speculative play and a retail investor obsession by the same analysts who missed 2008, missed 2020, and are currently telling their clients that the economy remains fundamentally sound. But here's what those analysts are not putting in their reports. Silver is not just a monetary metal waiting for a dollar crisis to justify its price. Silver is the most industrially irreplaceable element in the fastest growing energy infrastructure build-out in human history. And the world is running out of it. The numbers are not projections. They are not models built on optimistic assumptions. They are documented figures published by the Silver Institute, the industry's own data authority. And they tell a story that the mainstream financial press has almost entirely failed to communicate to the people who need to hear it most. In 2023, the solar panel industry alone consumed approximately 170 million ounces of silver. In 2024, that figure pushed toward 200 million ounces. In 2025, with solar infrastructure deployment accelerating across China, India, and the broader developing world, the number climbed further still. The total annual global mining supply of silver is approximately 850 million ounces. When total industrial demand, jewelry consumption, and investment demand are stacked against that supply figure, the result is not a projected deficit. It is not a modeled deficit built on assumptions that could be revised downward. It is a confirmed, documented structural deficit where demand is actively exceeding supply right now. Every single year that deficit persists, the coiled spring tightens. But the industrial story, as significant as it is, represents only one dimension of what is building beneath the surface of the silver market. The second dimension is monetary, and this is where the mathematics become truly difficult to ignore. The M2 money supply of the United States, the broadest practical measure of dollars in circulation, currently stands at approximately $21 trillion. The total above-ground investable silver stock, meaning silver in refined form that is actually available for investment purposes, is approximately 3 billion ounces. Divide $21 trillion by 3 billion ounces. The result is $7,000 per ounce. That is the ratio of existing dollars to available silver in the current monetary system. That is not a price target. That is a mathematical relationship that illustrates with cold precision how radically undervalued silver is relative to the money supply that has been created around it. If silver were to reprice to just 5% of that theoretical M2 ratio, the price would be $350 per ounce. At 2%, it would be $140 per ounce. The $100 target that serious analysts are currently discussing is not the ceiling of what the mathematics supports. It is a conservative milestone, an early waypoint on a journey the numbers have already mapped. But numbers alone do not move markets. Mechanisms do. And the mechanism that has kept silver suppressed, despite the structural deficit, despite the M2 mathematics, despite the industrial demand surge, is one of the most sophisticated and deliberately engineered price control systems operating in any commodity market in the world today. It runs through the COMEX futures exchange. It is financed through the repo market. And it depends entirely on one condition remaining stable: cheap overnight funding. Here is how it works with precise clarity. Large financial institutions carry massive short positions in COMEX silver futures. These are not ordinary speculative bets. They serve a specific institutional function. A rising silver price in the current monetary environment is a visible public declaration that the dollar is losing its purchasing power. And a dollar that is visibly losing purchasing power creates the kind of political and financial stability problems that the institutions profiting from dollar supremacy are deeply motivated to prevent. So the shorts are maintained. They are rolled from contract month to contract month using the repo market, the overnight and short-term collateralized lending system, to finance the carrying cost of those positions at acceptable rates. This mechanism was not a conspiracy theory constructed by retail investors on internet forums. It was prosecuted by the United States Department of Justice. JP Morgan paid a fine of nearly $1 billion in 2020 after admitting to systematic spoofing of the precious metals markets, placing large fake orders to artificially move prices in a desired direction and then canceling those orders before execution. Documented, admitted, prosecuted. That is the visible edge of a suppression system whose full depth runs through the repo market in ways that are structurally invisible until a liquidity event exposes them. And a liquidity event signaled by a 10-year Treasury yield crashing to 4.03%, is precisely what is unfolding right now. When repo funding tightens, the cost of maintaining those massive short positions rises. When the cost becomes prohibitive, and when simultaneously a recession environment is driving institutional money towards safe haven assets, and when the Federal Reserve is being forced to cut rates and expand its balance sheet, the short covering that follows is not gradual, it is not measured, it is a cascade, a gamma flip, a violent and compressed repricing that the algorithmic trading environment of 2026 would execute not over months, but over days. Four forces are currently applying upward pressure on silver simultaneously. Monetary debasement from a Federal Reserve with no exit, industrial structural deficit from an energy transition that cannot function without silver, geopolitical demand from central banks and nations repositioning away from dollar dependency, and algorithmic short covering from a suppression mechanism running on borrowed time in a deteriorating liquidity environment. Against those four forces, there is one force applying downward pressure. A paper market short position financed by overnight funding in a repo system that the 10-year yield is telling the world is under severe and growing stress. Four forces up, one force down. And the one force down is not built on fundamentals. It is built on borrowed money in a system that is running out of time to keep lending it. There is a restructuring happening right now that will not appear on any mainstream financial publication until it is already complete. It will not be announced at a G20 summit. It will not be declared in a Federal Reserve press conference. It will not be acknowledged by the financial anchors on television who have spent their entire careers operating inside a dollar-centric world and cannot yet see, or will not yet say, that the architecture of that world is being quietly dismantled. It is happening in the decisions of central banks, in bilateral trade agreements, in the construction of alternative payment infrastructure, in the gold vaults of nations that watched what happened to Russian dollar reserves in 2022 and drew one permanent conclusion. The dollar is no longer a neutral reserve asset. It is a political instrument, and any nation holding its wealth in dollars is one geopolitical decision away from having that wealth frozen by Washington. That realization moved, quietly, deliberately, and at extraordinary scale, directly into gold vaults. The numbers tell the story clearly. 2 decades ago, the dollar accounted for over 70% of global foreign exchange reserves. Today, that figure stands at approximately 58%. That decline represents trillions of dollars reallocated away from dollar-denominated assets toward alternatives that cannot be frozen, cannot be weaponized, and carry no counterparty risk. The primary alternative those central banks have chosen is gold. China's official gold reserves have grown substantially, but analysts studying Chinese reserve management believe official figures dramatically understate actual holdings, accumulated through state-owned vehicles specifically designed to build strategic, hard asset positions without telegraphing the full scale to markets. Russia has been accumulating. India has been accumulating. Saudi Arabia, whose 1974 agreement to price oil exclusively in dollars created the petrodollar system underpinning dollar supremacy for 50 years, has been quietly adding gold while publicly discussing acceptance of non-dollar energy payments. Poland, Hungary, Turkey, Czech Republic. Central banks across the full global spectrum have been adding gold with urgency that has no precedent in modern financial history. But here is the dimension almost nobody has connected to silver specifically. The nations most aggressively moving away from dollar dependency are the same nations most aggressively building the solar energy infrastructure that cannot function without silver. China deployed solar capacity in 2024 and 2025 at numbers that staggered independent energy analysts. India's national solar ambitions require silver quantities the current global mining industry cannot supply at anywhere near current price levels. The broader developing world, building energy infrastructure from scratch rather than transitioning from legacy systems, is deploying solar at a scale existing silver supply chains were never designed to accommodate. This creates a convergence historically unprecedented in commodity markets. The nations repositioning away from dollar dependency are simultaneously creating the most intense industrial demand for the one commodity, serving as both a monetary alternative and an indispensable energy input. Silver is caught at the intersection of two of the most powerful macro forces in the global economy. Monetary realignment pulling it upward, industrial demand pulling it upward, from the same direction, driven by the same nations, at the same moment in history. Now add the Shanghai dimension. The Shanghai Gold Exchange has been operating for years as a physically deliverable alternative to the COMEX paper market. Its volume has grown, its institutional relevance has expanded, and its fundamental architecture, settlement in physical metal rather than paper contracts, directly challenges the suppression system whose entire effectiveness depends on paper, dominating physical in global price discovery. As more commodity trade migrates toward non-dollar settlement infrastructure, as BRICS payment architecture moves from concept toward operational reality, the paper market's ability to hold silver below its fundamental value begins to erode. And when that erosion reaches a tipping point, It does not gradually adjust. It snaps. This is the complete picture that the 4.0's 3% yield is sitting inside. Not just a domestic American recession signal, a yield moving inside a global monetary system undergoing its most significant structural realignment since Nixon closed the gold window in 1971. When that window closed, silver moved from $1.50 to $49 by 1980, a 33-to-1 return, driven entirely by dollar debasement, driven entirely by the same dynamic now playing out in a more compressed and more dangerous form in February 2026. The business community watching this moment has one decision to make, not emotional, not speculative. A cold, calculated, strategically reasoned decision based on signals that serious analysts examine when financial architecture shifts beneath the surface. The bond market has spoken. The yield has moved. The Federal Reserve's history is documented. The silver deficit is confirmed. The M2 mathematics are verifiable. The central bank accumulation is publicly recorded. The BRICS realignment is already partially operational. Every signal points in the same direction. Silver is not waiting for permission to move. It is waiting for the mechanism holding it down to run out of money. And the 10-year Treasury yield at 4.003% is telling anyone paying attention. That moment is no longer coming. It is here.